Separated into 5 main panels, viewing the profile page is not unlike scanning the dashboard of a well-equipped sports car. Important information about direction, efficiency, and potential problems ahead are quickly conveyed. The top panel identifies the average risk characteristics of the individual holdings within the two portfolios being compared. Average total risk represents the weighted average option-implied volatility. Each company's volatility is updated daily. This allows Alphacuity to generate a true, forward-looking estimate of risk. In the next 3 lines, total risk is decomposed into independent contributions of systematic, factor, and company-specific risk. The average systematic risk is that portion of total risk commonly shared across all securities within a region and is uncorrelated with the broad market. Average factor risk is the risk component associated with the shared traits of identified thematic portfolios independent of systematic risk. In other words, factor risk represents the common covariance among a group of companies with the same factor exposure. Average idiosyncratic risk represents the residual risk remaining after removing systematic and factor risk components. It's the company-specific risk unique to each holding and is uncorrelated with all other risks. How is this information useful? This table provides a quick snapshot of the portfolio's general risk characteristics. Does the portfolio have higher or lower risk than the benchmark? Which dimensions? What degree? In essence, what stands out? The second panel shows information related to portfolio diversification. This includes number of holdings, or the number of unique equity securities in the portfolio. The effective number of stocks, on the other hand, is a measure of portfolio concentration and ranges between 1 for a single stock and the number of holdings for an equal-weighted portfolio. It's a driver of diversification efficiency for company-specific risk. The higher the valuation in position weights, the lower the effective number relative to the actual number of holdings. Active share represents the portion of portfolio holdings that differ from benchmark holdings. Index funds will exhibit low active share, while concentrated funds will generally be high. Factor average cross-correlation, as the name implies, is the average level of cross-correlation for the active portion of the portfolio. The higher the cross-correlation, the higher the risk from industry over or underweight positions. Effective number of factors is best interpreted as the number of independent factors that would yield a comparable level of factor diversification. Think of it as the factor corollary to the effective number of stocks. Rounding out this section is portfolio beta, which is a relative measure of sensitivity to market risk. The third panel brings together the information shown above to generate an overall assessment of risk. The contribution from each segment is color-coded and shows selected summary details, including risk orientation and level in both absolute and relative terms. Fuller analysis with greater detail is accessible on dedicated pages. Tracking error is defined as the standard deviation of the difference between the portfolio and benchmark historical returns on an annualized basis. Alphacuity takes this to another level. Tracking error using the Alphacuity Risk Analyzer is a forward-looking or ex-ante measure of portfolio risk derived from the aggregation of systematic, regional, factor, and idiosyncratic sources of risk. Active tracking error is simply Alphacuity's measure of tracking error divided by active share. It is a comparable measure of risk across all levels of active share and a component of the diversification efficiency ratio. Again, as implied by the title, the diversification efficiency ratio measures how well the active portion of the portfolio is diversified. The pie chart in the fourth panel gives a visual reference of the tracking error breakdown. It's a quick and easily interpreted depiction of the dominant sources of tracking error risk, potentially indicating areas for further exploration. Finally, the fifth panel shows the size capital risk chart. It plots the location of the portfolio and benchmark based on the size and capital risk attributes. Size risk reveals market capitalization characteristics of the portfolio as compared to a series of benchmarks. Capital risk represents the financial flexibility of a firm to access capital, if necessary, in more difficult market environments. The blue line is plotted for reference and connects a series of market indices ranging from large to small. The market index line generally moves to the right as size falls, indicating a strong correlation between size and capital risk. Clicking on this chart toggles to a second view, separating the portfolio into three distinct parts associated with the active share analysis. The size capital risk characteristics of each part are identified on the chart. Overlap pinpoints the characteristics of that portion commonly held by the portfolio and benchmark. Overweight represents the location of the long positions in the portfolio, while the underweight represents the location of the short positions relative to the benchmark. Comparing the overweight versus the underweight can indicate a strategy bias or manager preference along the size or capital risk dimensions. In conclusion, understanding the information presented on the profile page can help you decide where to navigate for more detailed analysis. Alphacuity. Risk insight clearly communicated.